Now, Intel has historically been one of the world's largest semiconductor companies, with its core focus on designing, manufacturing advanced microprocessors, which serve as the brain of modern computing devices. But beyond this, Intel is also involved in a wide range of activities. Now, just in 2024 alone, it is down around 60%, which is in fact a decade low for Intel Corporation. When we take a look at the semiconductor industry as a whole, it has performed very strongly. We have Nvidia, Broadcom up triple digits, as well as positive performances from others. Notably though, Intel and AMD have been one of the worst performing. Now, in terms of where things have gone wrong, well, most recently we did get information that the CEO, Pat Gelsinger, has been ousted. Now, whether this was his decision or in fact the board pushed him out, we can see his reign at this company has come to an end. And if we just look back at 2023, we should have started to see some signs of weakness when the company cut their dividend by more than 65%. We then move on to 2024, where they had their worst day on Wall Street in 50 years. And as we mentioned, their share price did fall to a decade low. Not only that, they actually removed the dividend completely. So they are now not a dividend paying company. And as we said, they are looking at more ways to reduce their costs in what has been a very poor year for Intel. Now, there are some positives to note. When we just look at their latest earnings, we can see their shares did jump up around 7%, although we do note that it has given back quite a large amount of those gains. And what they did do, when we take a look at the actual numbers themselves, they did have some very impressive numbers. They reported 17-cent positive EPS. Market was anticipating a loss of 2 cents, and their revenue, whilst only marginal, was still a beat, which is very good. Also noting, as we said, they did increase their overall guidance. Other thing that we have noted from just last month was that the finalized agreement of the CHIPS Act grant at $7.9 billion did come into fruition, and that will ultimately help their manufacturing expansion, something we have seen already come to fruition. Now, is this company, which is down at a decade low, negative 60%, trading at its 52-week low or thereabouts, a company we should consider for 2025? Has the market ultimately overreacted, and are we anticipating a lot of growth moving forwards? We're going to get to that in today's episode. And before we get into the numbers, the metrics, there are a few key points that we do want to highlight. Now, 2024, they have faced several challenges and milestones as they do want to maintain or try and gain a better position in the overall competitive semiconductor industry. As we've already highlighted, they now have leadership change. The CEO retired in December. That is a massive leadership transition, so it will be interesting to see how the interim CEO comes in and maintains that momentum with the challenges that they do face in both AI as well as the chip markets. One thing that we do like to highlight are the technical advancements they have had. They've made progress in manufacturing innovations. Now, there are some new technologies and new process nodes we won't get into, but it is something that they are looking to reclaim their leadership in the semiconductor process technology, a race in which they do compete quite closely with Taiwan Semiconductors. In terms of the manufacturing and expansion, well, they have invested quite heavily in a lot of new labs and manufacturing upgrades worldwide. That is facilities in Arizona, Ohio, Germany, and Malaysia. And with this new CHIPS Act finally being completed, hopefully we can see these investments aim to effectively increase production capacity and develop cutting-edge chips. Finally, we just want to touch upon these strategic moves. Now, they are diversified in terms of their portfolio. They're entering the automotive sector with AI integrated chips for electric vehicles and selling stakes in their non-core businesses, such as their Articulate 8 AI software startup. What this has shown us, they are looking to capitalize on emerging markets whilst ultimately focusing on their core manufacturing. So 2024 as a whole, quite a transformative year for Intel, characterized by significant investment in innovation, restructuring, and their efforts to regain technological leadership. However, they have faced challenges in execution, competition, as well as market sentiment, which continues to test their overall resilience. So now let's take a look at their earnings. Now, the predictions over the next few quarters does look very mixed. Some quarters double-digit decrease, some years triple-digit increase. But when we look at over the last 4 quarters for Intel, and with a 50% track record looking back, whether or not that does give you faith in their next full year, where they anticipate just under $1 per share, we can see this will ultimately bring the forward P to around 21. We notice it is negative currently, therefore we get a negative forward P for December 2024. Now, as we mentioned, they have now fully cut the dividend, but as we can see, over the last full year, it was a negative 49%. On average, if you've been holding the dividend over the last 5 years, it is down 9% year on year, although over the last 20, up 12%. But as we can see, they have now fully, whilst they have said it is a pause, they have pretty much cut the dividend. Now, free cash flow payout, as always, we like to draw your attention to the free cash flow over the earnings data, which is susceptible to manipulation by management through accounting. Not much to talk about in terms of the payout. As we said, the dividend is no longer applicable. Whether or not they bring it back, that is something that is remained to be seen. In terms of the free cash flow per share, well, it is negative over the last 2 years. Prior to that, it was nice positive, and we want to see consistent increases over the longer term, not something we do currently get. Remember, they have faced a lot of challenges in 2024. Sales growth, top line, at the bare minimum, we want to see 3 to 4% just to keep up in line with inflation. Something you could argue they did have on average prior to 2022. Over the last 2 years, though, double-digit decrease to their top line. Nice to see on a trailing 12-month around 3%. So maybe in 2024 we will get a year where they do increase their top line, although just marginally in line with inflation. And you can see the numerics here. In 2014, 56 billion. In 2023, they actually reported less than 10 years ago. Now, shares outstanding, we always highlight this. We want to see companies that return excess cash to investor pockets through those share buybacks, something they have done over the course of the last 10 years, although we do want to flag from 2021, they have actually done the opposite and diluted your position. So depending at which point you have bought shares, we can see they have done both share buybacks as well as share issuances. ROIC, one of our favorite metrics, 10% or more, give us faith management are able to effectively allocate their capital. Now, 2022, 2023, not looking good at all. Negative 1% on a trailing 12-month, not something we want to see. But as always, we will factor these in to our margin of safety when we get to the valuation process towards the end. Now, operating margin, 2 things we want to see: minimum 16% that we don't get in the most recent period. And also we want to see efficiencies with the margin growing over the longer term. Again, not something we see. Definitely a red flag indicator, 0% in 2023, negative 1 on a trailing 12-month. Looking likely that they will report a loss for the full year of 2024. And in terms of the free cash flow margin, above 5%. We get that every year up until 2021, not looking good over the last 2 years. And as we saw above, it was in fact free cash flow negative over the last few. In terms of net debt to EBITDA, again, one of our favorite metrics alongside the ROIC. EBITDA referring to the earnings before interest, tax, depreciation, amortization. And for this industry, the semi space, we want below 1.5. Now, this does correlate, by the way, to dividend safety, which they don't pay anymore, as well as balance sheet strength. And these numbers that you see are the number of years it would take them to pay off all of their debt net of cash on hand. Not only has it been increasing from 2021 at 2.26 on a trailing 12-month, but also above the 1.5 threshold. So that is a little bit of a worry that it has been increasing as well. Only positive thing we would say, it is anticipated to come down over the next 12 months. But again, these are things you do need to factor in when considering this company in your overall portfolio. Now, we want to let you know we have released our latest free weekly article where we talk about one stock we are buying heavily in the month of December. Now, you can grab a copy by clicking on the pinned comment below, and we drop one of these to your inbox every Monday morning. So a new one is coming tomorrow where we highlight severely undervalued stocks for your attention, as well as what's gone in the market over the last few days. And you will also be able to grab a copy of 28 undervalued stocks for the month of December. Lots of information for each one, as well as the upside that Wall Street themselves see over the next year. And on top of that, you can grab a recently released copy of 29 stocks that Wall Street themselves believe have the most upside right now in the S&P 500. So click below, you can sign up and start reading straight away. We then like to look at insider ownership, which sits very low at 0.04%. We get around 751,000 worth of buys over the last year, and in the same time frame we get a little bit less in terms of insider selling. In terms of the most recent quarter though, Q4, we get 650 worth of sales. Now, full transparency, we will show you who these insiders are, but in terms of insider selling, not something we do focus on. We don't see it as a bearish signal, as they sell for many reasons, personal and financial. 7th of November, we get the EVP selling 25,000 shares, netting them $650,000. Again, information is there if you want to use it in your own investment thesis. Institutional aspect, 65% ownership, $7 billion worth of sales over the last year. We get nearly double the amount of buys at around $13 billion during the same time frame, although in the most recent quarter we get a little bit more selling than buying. As always though, do your own due diligence, never copy insiders, never copy institutions. In terms of the income statement, now we've already flagged their top line revenue, which if you do also want to consider the movement due to the cyclical nature of the industry, that is something to bear in mind. But as we have mentioned, it has been decreasing over the last 2 years. But no, that isn't what we want to focus on right now. We want to draw your attention to the bottom line, something we haven't yet covered. Does it follow a similar story to the top line? And you'd probably say a little bit. It is also very, very inconsistent, but we do notice December 2023, a very small net income reported, and as we can see, 1.7 billion with the previous year at 8 billion, and in fact on a trailing 12 month, it does, as we mentioned before, look likely they will report a net loss. Again, things just to consider. Then we move on to the balance sheet, a quick health check, total cash versus total debt. We did raise some concerns about the net debt to EBITDA, and the cash over the longer term, whilst inconsistent, has increased from 14.4 billion in 2014 to 24.1 in the latest quarter. But remember, one number here in isolation will give nothing away, which is why we compare it numerically and directionally to their total debt, which pretty much the most consistent metric we have seen today, increasing over the longer term, 14 billion in 2014 to 50.2 in the latest quarter. And as we mentioned earlier on, the net debt to EBITDA has been increasing over the last few years. We then just want to highlight one part from the cash flow is the cash this company is generating from their operations. And as we can see, not particularly great, decreasing over the last 4 years. 20.4 billion in 2014, 11.5 in the latest annual accounts, which has only been decreasing from 2020, and as we can see, based on the trailing 12 month, anticipated to continue that decline. Now let's jump into some gradings. The first one is the valuation, where they get a D+. Now, no surprises on the P non-GAAP forward-looking basis. We don't get a figure here right now. As we saw, it does look to be negative, but we can note the sector median at 26.25. If they do hit their next full accounting period, the forward P will come to around 20, which will be lower than the sector median. However, if you do want to take a look at other valuation metrics, what this highlights, given the B and A ratings, is that this company is trading at a discount. For example, on the price to sales, the price to book, the price to cash flow, as well as some others. We then highlight the growth grade, where they get an F. Now, revenue year on year, 3%, sector just under 5%, forward looking, -4%, sector median, positive 5.6%. And one thing we do like to draw your attention to, which looks fairly favorable for Intel, is earnings per share growth over the next 3 to 5 years, 25% year on year, with the sector median at 15.3%. We then finally close on the profitability, where they get an A rating. Gross margin, 40, lower than the sector at 50. Their bottom line, -30%. As we said, very likely they will report a loss in 2024. Sector median, positive 3.8%. Although one thing we do note is their cash from operations, as we highlighted earlier, 9.8 billion, as opposed to the sector median at 97 million. Now, quick recap for this part of the analysis, a triple hold from Seeking Alpha, Wall Street and Quant, with a valuation D+, growth F, and profitability A. Now, two things before we jump into our own valuation DCF model is their comparison against others in the semi space of a relatively similar size. Now, total return includes the dividends reinvested that they had given not too long ago. Over the last 12 months, the worst performing, -54%. Bit of a mixed bag in the industry, some performing very well, some performing not as well. When we expand this to over the last 5 years, we can see again the worst performing and the only one with a negative return. over the last 10 years, when we do the same comparison, the same result still shows, meaning if you had invested $10,000 in this company 10 years ago today, right now you would be sitting on less than that amount, even if you had reinvested those dividends on a quarter by quarter basis. Now, do bear in mind, past performance isn't reflective of the future. They could perform significantly better, but they could actually also perform a lot worse. Final thing then is looking at the comparison against the S&P 500. Although I'm sure you already know the results, S&P outperformed over the last year, S&P outperformed over the last 5, and S&P outperformed significantly over the last 10. Just bear in mind, we're highlighting this in case you don't have that faith that the company will outperform something it hasn't done over the last 10 years. Then do bear in mind low-cost ETFs that track the S&P. Now let's jump into the valuation process, where we have an intrinsic value today at $27. This is derived from the DCF model, and when we do show you this through essentially how we got there, we have the free cash flow growth year on year. Now average is negative, no surprises, gone from positive to negative a few number of years. Now for the 2024 rate, right now we have gone from around 9 billion, which is something they hit in 2021. In fact, it is the lowest free cash flow positive, so that is something we are just doing as an expectation. So bear in mind that is fairly subjective. Alongside the growth rate, now we want to be very, very conservative at 0%. With a discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we can get $27, which means right now there's upside of 35% if they don't grow their free cash flows moving forwards, and if they do get to around 9 billion over the next few years. Now remember, these numbers are subjective, and you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Intel or any others. But full transparency will show you at the 4% rate, it would give an intrinsic value of $36, 82% upside. And for those that are a lot more bullish, at the 80%, $48, indicating 142%, more than a double from this point. Now, today's episode, we want to be extremely conservative and take the 0%, so the low rating, especially as we are being a bit more subjective on the future free cash flows. Now, what we always do is we can apply a margin of safety where we start off with 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that, a buy up to around $24, then we keep going till it's near the current trading price. And what we can see in today's episode, up to around the price right now of $20, you are getting a 25% MOS. With Wall Street themselves, whilst they do have that hold rating, they see the share price at $25 over the next year, and that equates to 25% upside. So 25% MOS, 25% upside. Is this one you are considering for your portfolio? Do you believe there is a turnaround play here with a new CEO to come in, with the CHIPS Act, with a lot of innovation and growth they are anticipating? Or in fact, is this one that you don't like at the current price? Maybe you prefer some of their competitors like Taiwan Semiconductors, or maybe the way you want to play the semiconductor space is just by investing in a low-cost ETF like SOXQ or any others. Do give us your thoughts in the comments below. Don't forget to sign up to the free weekly newsletter. We are dropping one tomorrow morning. Grab those spreadsheets and come and join us in a Patreon where we do talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.